Hi, everybody. I am Dr. Jones, and we are moving on with our example for Module 2 in this Bootcamp prep. So in the first video, we talked about adjusting journal entries and the need that we had to adjust these various items to account for, basically, these were all expenses that we had used up during the year. So we had, during the month. We had recorded these entries down here in the bottom of our journal entry section, and then we also posted them to our T accounts. So the next step in this is to do the adjusted trial balance. So previously we had a trial balance. All a trial balance is listing out all of our various accounts and whether they are a debit or a credit, and we know that all of our debits have to equal our credits. So now that we have some new accounts, or some new entries that we have recorded, we need to update this trial balance. So this is very easy. All we need to do is pull over those balances from our T accounts. So we'll go over to our T accounts and we can just pull in all of these balances. So if you'd like to pause the video and go ahead and do that at this time, that would be great. I've already done that for each of these. So pause the video and go ahead and do that on your own and pull in all of those T accounts. After you have done that, you should find your balances are the same as we see here. So what I would like to do is look at our trial balance before we did the adjustments and then after we did the adjustments. So before we recorded these adjustments, we really only had one expense that was reflected here. So all of the items that we were adjusting for were expenses that we had used up. So we had rent, we had utilities, we had software, we had supplies, we had depreciation. It's in the wrong spot. Let me fix that. So we have that depreciation, and then we also have supplies. So one thing we know about our trial balance is it always has to balance. So I'm going to do a quick sum here, and I'm summing up everything in my debit column, summing up everything in my credit column, and I see that those two match. That's very important. Our trial balances always need to balance. The next step is to put this information into our financial statements. So I have two financial statements on the first sheet, which is our income statement and statement of stockholders' equity, and then I have our balance sheet. We're not covering the statement of cash flow in these videos, but it is something you'll need to know in the future. So what we have next are our financial statements. So if we look at that trial balance, it is ordered basically as the order of what we need for our financial statements. So we start off with our assets, then we have our liabilities, then we have our equity, then we have our revenue, then we have our expenses. So if our trial balance is ordered, it's very easy for us to tell which accounts need to go where. We know that our balance sheet equation is assets equal liabilities plus equity. So that means that all of our assets and all of our liabilities and our equity are going to show up on our balance sheet. So all of these accounts will show up on the balance sheet. And then we know that all of our revenues and expenses will show up on our income statement. So we know these ones are all going to be income statement accounts. The little difference that we have, that statement of stockholders' equity, that's really going to reconcile between the two accounts. It's kind of that intermediary, and it's really relating to our retained earnings, common stock, if we had dividends. Those are the things that would be reflected on that statement of stockholders' equity. So these two accounts we will also see on the statement of stockholders' equity. So now that we know what goes on which account, we can go through and simply put them where they're supposed to go. So our income statement is always going to be revenues minus expenses, and that's going to give us our net income. So our revenue in this case, we only have one, is going to be that credit for our counseling services. So we have $2,300 worth of revenue. Now we're going to go and pull in all of those various expenses. So we had rent, we didn't have anything for office, then we had software, and then we have utilities, and then we have depreciation, and then we had supplies. So we see this, the total expenses, or those total operating expenses, is going to be all of those various amounts. And then our net income is whatever we have left over. So that net income flows down into this statement of stockholders' equity. So the statement of stockholders' equity really is going to show how we get from having $0 in retained earnings to what we're ultimately going to show on our balance sheet. So at the very beginning of the year, we had 0 in common stock and 0 in retained earnings. It was brand new. We didn't have anything there. Then we went ahead and issued some common stock. So we had $25,000 of common stock that we had issued. And then we also had some retained earnings that we're adding. That's going to be that net income. That's going to close at the end of the year, end of the period, into that net income account. We don't have any dividends in this case. So we don't have any dividends showing in this statement of retained earnings. But if we did have dividends that we would pay, those would be shown as a reduction in that retained earnings. So we're showing at the end of the year that we have retained earnings of $25,517. This is what we will show as our equity on that balance sheet. So now let's go and show what that's going to look like. So our balance sheet is going to have all of the other accounts. So now we'll just pull those in. So I have my cash, and I have accounts receivable. Oops, hold on. Then we have our accounts receivable, supplies inventory. We don't have merchandise inventory in this example. Supplies inventory. We have prepaid rent. And then we have prepaid subscriptions, not insurance in this example. The last thing, so our current assets, we're going to divide our balance sheet into current and non-current. Our non-current expenses, we have land is never going to be depreciated. And then if we had other categories, they would be shown here as well. We really only have office equipment, so these two are not, or these accounts are not really necessary. So our equipment was that $2,000. And then we had our accumulated depreciation, which is going to be subtracted of $33. So this is going to be a negative amount. And then we're going to have the net of these shown here to show that that's the amount that we have left. So our total assets are $26,042. Now we'll go over to the liability side. So we'll pull in those accounts payable. Unearned revenue. I have some additional things here that we don't have in this particular example. So we don't have any wages payable. We don't have any interest payable. We don't have any notes payable. But these are different long-term and current assets that you might see sometime in the future. Then we have our stockholders' equity. So this is what we're going to be bringing over from that statement of stockholders' equity. So our common stock, we know that was 25,000. We're just going to bring it over from here to show how these things flow from one to the other. And then we have our retained earnings, which is really just what has closed from that net income account. And then we see that our assets and our liabilities are in line, that they agree. So the last part of this process then is going to be the closing entries and the post-closing trial balance. So that's what we are going to do next. So if we look at our chart of accounts or our trial balance, we have to think about what accounts need to close. So you may have heard the acronym PALS. just write this up here for you. So this means permanent are our assets, liabilities, and stockholders' equity. So those are permanent accounts. Permanent accounts mean they never go away. PALs will stick around forever. They don't ever leave. So if we were to close, let's say, our cash account and we zeroed that out, that would mean our cash went from 19,000 to zero just because the month ended. We wouldn't want that to happen, but we do want our revenue to start over. We want to know how much revenue we generate each month. So each month we want to have a start from zero. So basically, all of our income statement accounts are the ones that we're going to close. So we're going to need to do closing entries to close out these revenues and expense accounts. Now, you could either close them straight to retained earnings, or if you use the textbook that we use in 2301, they close them to something called the income summary. So there's 4 entries that they make. First, they close revenue to income summary. Then they close expenses to income summary. Then they close income summary to retained earnings. And then finally, they're going to close dividends to retained earnings. So we don't have that one today. All we have are the first 3. So we're going to close the revenues and expenses to the income summary, and then finally close that income summary to retained earnings. We know at the end of the day, it's going to be $517 that's going to get closed to retained earnings because that's the amount of income we had. So that's what we're going to do first. So I'm going to go over here and we're going to start by closing out that revenue to our income summary. So we know revenue is a normal credit balance account. So to close that, we're going to need a debit. So we are going to close 401 on 331x5, and that is going to be revenue, counseling revenue. And we will close that with a debit. So right now it is sitting here with a $2,300 credit balance. So to close that out, we're going to have a $2,300 debit balance. And again, we're closing that to our income summary. So if we were to have a T account for income summary, we would be recording that $2,300 to income summary. Now, the second one is to record our expenses to income summary. So expenses are typically going to have a debit balance. So we're going to have to reverse those with a credit balance to zero them out. So again, the whole purpose behind closing entries is that we want to start the month off fresh and know exactly how much it is that we are spending or earning during that month. So that's the kind of purpose behind here. So we have rent expense, office expense, software, utilities expense, depreciation expense, and then supplies expense. So again, these are all sitting there with the debit balance. So we need to credit these to close them. So if we're crediting these, I put them in the wrong column, then we're going to need a debit to offset them. So that's debit is going to go to that income summary. And the income summary doesn't have a number because it's really just a holding account until the end where we will close it ultimately to the retained earnings. So I'm just going to go back to this trial balance. I'm going to pull in each of these. I'm just going to pull this down. Hopefully that's correct. And then the income summary is just going to be the total of all of these. So now we have income 1783, and that leaves us with that net income figure that we had of 517. So the last piece, we have a credit balance now. Since this is negative, that tells us that the credit is greater than the debit. So that means we need another $517 debit in order to zero this out. That's what's going to go to retained earnings. So the last piece here is to debit that income summary and to credit retained earnings. Now, if we had a loss during the period, this would be reversed. We would have a debit to our retained earnings and a credit to income summary. But essentially, again, all we're doing here is closing out that total income into our retained earnings. The last piece is our post-closing trial balance. So remember, a trial balance is simply just a list of accounts that we have open and the balances that we have with them. Well, we've now just closed all of those income statement accounts, so all that we will have left are the balance sheet accounts. So we know that everything from our counseling revenue down is going to be zero because we've just closed all of those. So this is all going to be zero because these have all just been closed. But we still have that cash amount. We still have the accounts receivable amount. The only one here that's going to actually have changed is going to be retained earnings. So we added that $517 into retained earnings. So we have all of these accounts that should be exactly the same because, none of those have changed in those closing entries. The only thing that changed was that retained earnings amount because we closed that amount to it. So we're showing that $517 in that retained earnings. Now, we know that a trial balance has to balance. So the last thing I'm going to do here is show us that when we do this, that we are in balance. So that is all that I have for you today in Module 3. I believe Dr. Vega is going to, Module 2, Dr. Vega is going to do Module 3 with and going through that complete accounting cycle one more time for you so that when you see this again or something very similar on your entrance exam, it will not throw you for a loop and you're going to do great. I have lots of faith and I wish you all the best. Thank you very much. Have a great day.